people from our team, and we're all in the hub now in Kyiv. So I guess we can like slowly start. It's already 19:44, and I guess most of you already know, but we are now on coaching session with Mikela Druckman, co-founder and CEO of Greyparrot, and we'll have conversation like about startups, about seed, pre-seed, and what is important when you're building a startup, especially in Europe, and when you have like funds in USA and other countries, and how is it like to build a startup that is now like claimed to be one of 100 most promising AI companies in the world by Wired. And it's me, like my name is Anton, I'm hub lead at Lift 99 Kyiv. So we now have electricity, as you see, we have a shelter. So if you are not in Seyo now, even you don't have internet or electricity, so please come. We will be able like to welcome you here. And let's start, Mikela, please.
Thanks so much, Anton. Hi, everyone. So happy to be here. So thanks for inviting me. And I'm looking forward to spending some time with you guys this evening, and hopefully sharing some of my learnings in the entrepreneurial journey. So maybe to start with, obviously we're going to focus on fundraising and the different stages of fundraising. But to start with, I'll maybe start with a quick intro and kind of how I got here, so you can have some context also a little bit on my experience. So I'm originally from Switzerland and half Turkish, and I started my career, studied finance and thought I would go into banking and things like that, but very quickly understood it was not for me, and I got very passionate about the startup world. I'm sure like all of you, and when you start, hanging out with entrepreneurs and being in that world, it's, when when it's your crowd, basically. So that's what happened to me. So after my studies, I went back to Switzerland, and I tried to do my own startup right after uni. And that was like a marketplace for beauty services. So I joined an accelerator, was pitching, we got selected, I had a team, we worked for 6-9 months. And then it kind of fell through. And it was basically, I knew I was in the wrong market, and I had very little clue of what I was doing. And at the time, this was more than 10 years ago now, the ecosystem in Switzerland was very underdeveloped. So I knew I wanted to get somewhere where there was more startups and more of that atmosphere. And so I did everything to move to London. I joined a startup as well that helped other startups. I was doing a lot of business plans, international expansion, things like that. And then eventually met this company called Blippar that was doing augmented reality. So one of the very early players in AR, so what is today the metaverse. And same, there were about 20 people at the time, and I said, have to jump on this boat. And so I did everything to join that company and essentially help them enter new markets. So I developed the Turkish market to start with, and then led international expansion, became the chief commercial officer as well. And then that was an extraordinary journey, because I saw the company go from like 20 people all the way to 300 people, and then restructuring the company back to 70 people. And in total, the company almost raised 100 million. It was like a very big story of like up, down, restructure. So although I was not directly involved as a founder in the fundraising, I could see the different stages that we had gone through in scaling and in fundraising as well. And then in 2018, while we were doing that process, there was an opportunity for me to go with my co-founder, which is one of the founders of that business, and start a completely new venture with some people that wanted to come with us, especially experts in AI and machine learning. And we wanted to basically use our expertise, but also tackle one of the big urgent problems in the world today. So specifically for us, the waste crisis. And so we started Greyparrot in early 2019. And I'll talk a little bit more of that journey, because again, it might be a bit relevant for you guys, especially if you're a pre-seed seed. But essentially we set out with a very broad vision. So we were just a team, and we knew we wanted to use AI to tackle waste management or a similar big problem. So it was very broad. And it took us about 6 to 9 months to really do a lot of prototyping and iteration to get to the right idea. And then in those 6 months, we were able to raise a pre-seed from a family office that knew us quite well, that had worked with us before, and essentially that really trusted the team, and kind of the purpose, but there was really nothing. There was no product, and there was obviously no revenue either. And then after 6 to 9 months, we've really found our product market fit, or early product market fit, and we started building our first prototype, getting the first traction with the customers. And on the back of that, we raised our seed round. So that was a 2.8 million pound seed round. And that really allowed us to then scale the team. So from like 6 people to about 15 people, 20 people, and really start monetizing, building the product, and reach kind of a commercial stage with the product. And then earlier this year, we also raised a Series A of 7.5 million pounds, plus some grants on top of it. And so essentially that was on the back of traction and so on. On top of that, we also raised some grants. So I'll talk a bit more about this, but essentially this has been quite an incredible journey to be at the head of all of this. So I'll come back a lot to some of those examples and what we do, and of course, happy to answer questions there. So the first thing maybe to start with is let's maybe look at what are the general fundraise stages. And so I'm going to quickly share my screen here. And basically, when I was preparing for this talk, I was trying to find sort of a schematic, and I found this very organized chart with the different stages and who's there and step by step what happens. And I found this. I just want to say that it looks much more like that. So, the journey is, not straightforward. I'm going to talk to you about the different stages and how to do it. But in reality, there's a lot of ups and downs. A fundraise journey is not straight, right? So it's not that you go from angel, pre-seed, seed, Series A. There's lots of things that happen in between. Sometimes you need more time to find your product market fit. So you might go through extensions or convertibles. And then, these things move in different ways. So it is not a straight journey, but of course there are some general kind of rules and understanding around these things. And of course, certain VCs or angels that are more comfortable and invest in those, in those different stages. So I'll stop sharing screen and then we can come back to that. So I just want to start with, if we start at the beginning, obviously with pre-seed stage. And I want to talk about, of course, the fundraising journey, but also at the same time, how it feels in the company. And you might be experiencing this already, or you're about to start a company, or, a mix of both. But at the very early stages, you can imagine most of the time, there's no product. There's usually a team. There is maybe some proof points with the customers, and there's some kind of market understanding of, what is the problem that you're trying to solve. And so what that means is that at that point, it's everything about the team. So most VCs at that stage, or angel investors, will be looking at just you. Your ability to operate, your background, what you've done before, how you come across, your level of ambition. And I say this because I've done a lot of references for other VCs too. And the question I'm asked a lot of the time is this person ambitious enough? Do you think they have it in them? So I think being able to show ambition and resilience is really important, because they know that you're going to have to go through a roller coaster, to get to that scale. And so they want to see if you're really in for the ride, basically. So anything you can showing that resilience is really key. And then, of course, if you have any form of, past experience that's relevant, or, expertise in the sector, that makes a very big difference, or anybody that can vouch for you that is expert in the sector. So for us, for example, we were going into waste management. None of us had waste management experience. And so we had very early on kind of advisors and people that were helping us basically enter the sector and that were able to vouch for us as a team. So that made quite a big difference. At that point, you're also probably in a stage where, you're doing everything. So on top of fundraising, you're probably building the product and talking to customers and everything at the same time. And everybody that's with you, your founding team or few people that joined you early, are also probably have like 10, 15 roles at the same time. So in that phase, what I usually say is you need to find a bit of structure within the chaos. And so whatever you can do to give some rhythm to the company, that's really great. And so that might be 2-week cycles or 1-month cycles, but basically sense that you're trying to get to certain milestones. And the thing is, you cannot afford not to do that while you are fundraising also, because every little milestone that you might hit, like if you spoke to 2 more customers that say that they need this product, for example, you got 2 more people in your beta product online or something like that, makes a huge difference in your fundraise. So I think it's a phase where you need to try to do both. It's also, of course, from a volume standpoint, where there's the largest volume of startups, right? Because it's the beginning. So there's the valley of death right after, where a lot of startups don't make it to their first funding round. And so what's very important there is that you need to stand out. You need to imagine from like the angel and VC community that they are seeing like thousands and thousands of startups all the time, all wanting to conquer the world with great ideas, but there's really no proof point behind. And so anything you can do to stand out at that point will really help. So a few examples of that. So for us, what worked very well, for example, was being part of really well-renowned accelerators. And so it might be that you join them thanks to your sector. So for us, it was around AI, and we had other ones around like circular economy, for example. But basically, you tag yourself along another group that validates you in a certain way and makes you stand out. So for example, some of those accelerators had specific pitches for us to put us in front of investors, or they had press releases that said, this is the 20 top startups that we have selected in this sector that we think are the most promising in AI, for example. And so that just helps you go a little bit above the noise so that you have visibility. So at that point, anything you can do to get visibility is key. The other thing we did is that we somehow managed to get into TechCrunch Disrupt. So we had an early demo video. It was a very, very early prototype, but that allowed us to go into TechCrunch Disrupt and present on stage. So again, you start getting other validation points that are external, and you start like standing out from other companies there. So I would really think about in that phase how you can do that. And then in terms of types of investment, so I would say 3 primary ones. Obviously, angels, which are fantastic because they invest by themselves. So they invest a lot on conviction and on relationship. They don't have maybe the same multiple expectations of, venture capital. And so they will really take more of that risk if they have an affinity with you as a person or with your sector. So depending on what sector you're in, I would really try to find those angels that invest often in that space. So they might have a background in that, they might have an affinity in that, and anything you can do there. And of course, there's a lot of different angel groups. So for example, in the UK, you have a specific association for angels, and you can pitch in front of specific angel investors. So again, anything you can do to target those groups of angels, especially as a group. So if you can pitch to them like all at the same time or something like that, that makes a big difference. Grants. So this depends, of course, from country to country, but anything you can do with government grants, that's very helpful, especially if you're kind of in climate tech, that there's a lot out there. So any access you can get to that, that's really, really helpful. And then of course, some accelerators also have programs where they give you that initial capital. And then VCs, I would say that's also an option, but you will have to really target a super specific type of VC that is very comfortable with the very early stage. So that's a big point when you're trying to fundraise, is that you shouldn't try to go to every fund and every fund that you think has a good name and, you know, the big ones that everybody talks about. You really need to go to funds that are specialized and dedicated to the stage that you're in, and really find those people. So that's a little bit about pre-seed. Of course, I'm sure we'll come back to questions later, but I'll move a little bit to the seed stage. So once you get your pre-seed, you're kind of in a in a rush to really get your, you know, early product market fit, basically. But it's also a phase you need to accept it's going to change very fast, right? And there's no point on staying too long on an idea or a concept where you're not seeing traction. So you have to have really that mindset of extremely quick iteration, so that you can get as early as possible and as fast as possible to some form of product market fit. And that's going to be, you know, customer interviews, user testing, you know, whatever you're doing, getting yourself out there and just being very open to that change. As a founder and CEO, I have found that sometimes challenging, not for myself in the sense that I was quite comfortable with kind of that level of uncertainty and risk, but especially for your teams, that level of change and really quick change can also be a little bit unsettling. And I would really try to take them on that journey with you, you know, when you're going through those pivots and those iterations. And so the seed side, I think to be able to go for a proper seed round, especially if you're looking for quite a large one, it is important to have some form of product market fit. It might not be perfect, as in you might still iterate the product and the direction, but there must be some match between the problem that you're looking at and the solution that you're bringing, and ideally some form of technical de-risking. So, you know, in our side, you know, it's quite a deeply technical product with AI models and so on. So we really had to have the first AI models running that could show that, you know, we could recognize waste streams with a very high level of accuracy. So at that point, investors do want to have technical proof points, technical de-risking, and ideally some early traction. And so here, what I would really advise, and this is a big learning from, you know, having not done it good enough, is really trying to collect as much data in a structured way as you can from the people that you speak to. So let's say you're doing customer interviews, or you're doing user testing, or whatever you're doing to get that feedback. Do everything that you can to put it in a very organized, structured way, in a format that you could share it with an external party, including an investor, and say, you know, we have spoken to 200 users or 300 industry players, and this is what we've learned, and this is the outcomes, and this is why we know we need to go that direction, for example. Because even if, especially as a founder, you have that intuitive thing of like, you're speaking to people all day, you're making kind of these iterations and these pivots a little bit naturally, but being able to have the data points behind to give it to someone else to look at will make a big difference. Because at the seed round, you want to say, we basically eliminated these options. We know we are not going there, and we might be going this way, or that way, right? So you might not be completely clear, but at least you've removed kind of like 80% of options, and you're quite clear still in that direction. And there might be some iteration still on the product. At that stage, I would say you probably have like more 1 to 2 month cycles of rhythm of business and iteration and setting goals. So I remember at that point, we had joined an accelerator that was like kind of forcing us to put every 2 months some like really strong objectives and stick to them. And it was really during our fundraise, and it was really difficult, and I was quite annoyed with it at the time, but it really helped get the focus. And especially it's a phase where basically when you start fundraising, the goals of the business need to align with the goals of the fundraise. And sometimes those two are not exactly the same. So let me give you an example. You know, just as a general metric for a fundraise, you might need 3 customers on board for a pilot, right? But in reality, for the business, you might say, well, actually, before we do a pilot, we might do more research. This might, something like that. But you have to consolidate those together and make sure that the team is helping you with the fundraise. So even if they're not involved in like pitching to VCs, the work that they're doing and the milestones that they're getting to while you are fundraising will be very important to relay back to the investors. And often what I found in the seed round is that the investors, obviously, because things take, a few months from the first time you speak to them to maybe when they start doing their due diligence, they want to see in those 2-3 months what has been the progress, how you've evolved, what you've learned just even in those 2-3 months. So aligning the team around the investment goals will really help you, not doing that basically completely on your own. And then at that stage, of course, it's going to be about the team. There's going to be a lot of questions about the market size. So, you might have found a problem. You might have found an early customer and solution for it. But the big question that they will ask is this big enough of a market? And so really my learning and advice there is that you need to spend quite a lot of time doing that work. And, in every investment process, you'll get, kind of the analysts and the associates and kind of that checkpoint of like understanding the market size. And so the more you can do upfront yourself on finding ways to estimating your market, the easier it will be to explain and for them to trust your process of thinking. And even for yourself, frankly, as a proof point to make sure that you are going into the right direction. But this will be a big topic, and you will have to be able to basically justify, your market size in a quite detailed way. Of course, the tech proof point, as I mentioned, so anything you can do around having a demo, having something that they can touch or use or do live will make a big difference, because you're really going from like the theoretical idea to like that early excitement. And even if it's like a simple thing, just being able to give something to the investors to look at or to experience will really make a big difference. And then early traction, of course, this can look different ways, but you almost have to find what is the right KPI for you, right? So obviously, if you're doing a B2C product and you're looking at number of users onboarded, or if you're very B2B, that might be your first pilot. So there's no generic KPI there, but it's quite important to be able to find what are those metrics for yourself, and also as a range in your sector, and really go to market with that, to trying to get that before you fundraise or while you are fundraising. And I would even say, with some of those things, it's not even worth going out there unless you have found that. And so you need to make that quite clear for yourself and your team, when you go from that pre-seed to seed raise, like what are those things that we need? And one thing that's worked really well for us is that even if you're not fundraising, you can start having conversations with VCs before, like friendly chats, like, this is what we're doing. We're not raising yet. This is our idea. This is this. And then they will start asking you questions, right? Do you have that? And you can start reversing back, like, yeah, well, what would you expect from a company from us when we start raising? And you start getting a sense of, okay, for me to be able to be investor ready for that stage, this is what I need. And I would really strongly, again, encourage to have those conversations with VCs in between rounds, because you are not, you're not raising, so you're not in kind of, not desperate, but I mean, it's the dynamics a little bit different, because you're not asking for something. And at the same time, they need to start building their pipeline of founders that they found interesting. So they also have, an incentive and a KPI to be talking to founders that are doing cool stuff. So you're also kind of taking that box for them. And then you also learn in the process to how to prepare yourself, for that next raise. And I would say at the seed stage, obviously angels, grants, accelerators are still very good. and you start having kind of really early stage VCs that are very specialized again in that space. So for example, for us, it was Speed Invest, one of kind of the really good European seed funds. And I remember one of the things they said, so we were presenting them kind of our forecast, with all the forecast of what's going to happen and the financials and so on, which obviously is theoretical at that point. And they said, well, for us, we're not going to deep dive too much into that. Like the principles are there, but we know this is going to change 10 times. And this is really key because you need investors at that point that are not overly attached to your idea now or to your strategy now, because the likelihood that that's going to change is so high that you need investors that you feel can be with you on that journey. Because if you have somebody on your board at that point, and by the way, this is where usually you start bringing somebody on your board after your seed round, you just don't want someone that's rigid and that's not going to allow you to keep pivoting and iterating as you can. So you really need people that are ready to come with you on the journey, that are interested by the sector, that believe in you, and even though you have some direction, are ready to accompany you in those changes. So that's kind of where I would see the seed stage. And then for Series A, so this is a completely different story at Series A. It's, I would say, quite a big kind of uptick in kind of professionalizing the company that you need from seed to Series A. And this is why, like you've shown it in the previous chart, you see quite often kind of these extensions, right? Like you do a seed and then you do a seed plus, and then you might do an extension, a convertible, because you can stagnate in that phase for some time to be ready for Series A. Because the moment you go into Series A, you basically are really moving towards much more financial metrics, where funds will be looking at revenue traction, ARR, MRR, so monthly recurring revenue, annual recurring revenue, revenue close with pilots, and so on and so on. And so the story and the prototypes and the early traction and kind of more that storytelling, of course, has a place to play, but it's starting to really be alongside numbers and really kind of those financial metrics that you need. So when you're going through that transition, I would just say, again, you need to be quite aware of what the market is asking. So the generic metric is that at Series A, you need, $1 million ARR. Now, of course, that really doesn't mean anything, because depending on your business, this might mean very different things. But unfortunately, this is how a bit the VC world works. There's kind of these unwritten rules where at different stages you have these different milestones. And so you have to, again, understand for yourself, what does a comfortable level of traction mean for Series A? And ultimately, at that point, what they want to de-risk is the product market fit and the customer's willingness to pay, right? And the business model. So at the seed round, you kind of de-risk the tech, right? So there's some kind of proof points there and early product market fit, but maybe not monetization yet. And by the time you get to Series A, they want to see paying customers. And ideally, they want to see recurring paying customers. So they're paying you not just for like as a one-off for something, but they're paying you a license, they're paying you, on a regular basis, and they can see that continuity month by month or year on year. And also they want to see some form of repeatability. So they don't want to see, again, that you're selling, for example, to one customer something, and then you're selling to another customer something. So there's been sort of a productization that has happened, and that the same product can be replicable and sold in a consistent way to multiple customers. And therefore that gives them a view of how that kind of scale could happen. And so that's kind of really the stage that you're at. So in between your seed and your Series A, really what you have to focus on is like that repeat customer, understanding the sales journey. So similarly, when you were doing your pivots, this is where I would really encourage a lot of documentation is around the sales, the customer sales journey. What happens at step one, how long it takes. This is a lot for B2B. Of course, if it's for B2C startups, those things are slightly different. This might be, for example, the onboarding process, how much churn there is for your product, and so on and so on. But really, they're going to go very deep into that, into that funnel and how that sales pipeline happens. At that point as well, obviously your team would have grown. So they will be looking at the founders, but they will also be looking at your exec team or senior team or, key people in the team and your ability to attract talent. And so obviously it doesn't mean you need to involve everybody in the fundraise, but really highlighting those profiles and your ability to attract, very, very talented people will make quite a big difference. And then the market is still very important. So it was important at seed, but it still remains here because they want to see, one, that market is large. And if it's not large enough, basically that you're able to go to adjacent markets, right? And so like you might be doing this for this customer, but once you've nailed this vertical, for example, you might go to another vertical where where you can do the same. So you might want to be telling a story of how they're going to see kind of that growth in sales, but really that exponential return that you may have. And then at that point, I would say in terms of rhythm of the business, we're really looking much more at kind of a quarterly rhythm, like you start getting more in a usual business rhythm. And similarly, how do you align the team on business goals, but that also serve the fundraise? And ideally at that point, as a founder, you might be very busy fundraising, but the team is still running on the ground and getting customers and supporting. And again, anything you can do to show that traction while you are fundraising will make a very big difference. And so focusing really the team on all of that helps a lot. And then of course, at that point, like angel starts becoming difficult because the valuations, starts becoming too high. You can still get grants. Accelerators also starts becoming difficult. So you're really now entering kind of prime time VC territory. And I would say, in the recent years, it's been a bit quite blurred lines between what's a seed VC, Series A, Series B, like it's all, some are moving earlier, some are moving later, and you'll have to do a big selection process, when you're trying to find that fit. And you will have funds that call themselves, for example, Series A investors, but that depends because some of them take a risk that is bigger. So for example, you might be very early revenue, not like 1-2 million ARR, but they're still comfortable because they see the product. You maybe have a match with them in terms of the industry you're operating in. And so they might want to do that with you. But if you're going to, another type of fund, they will also do Series A, but actually they want a much more mature Series A where you have those traction points and so on. So you're going to have to gauge and do a lot of that filtering at the beginning. And then I'm not going to spend too long on Series B because I, from what I understand, you're all more early stage, but again, important to understand those transition points. And then the big transition point between Series A and Series B is what we call go-to-market fit. And essentially that means you found your customer, but now they want to see how you're going to completely scale to those customers. So, if you were selling, for example, 1 by 1 to a customer, they want to see how you're going to go from acquiring 10 customers to acquiring 100 customers and how you're going to do that in a very effective way. And this is where unit economics come in, where essentially for each product that you sell, they want to see the cost behind that. So the cost of sale, the cost of goods and so on. But really, what is that unit economics for what you sell? So not what you're spending really, because usually at that stage, nobody's profitable, but they want to see if actually you had an influx of cash that you could actually scale that and that your unit economics make sense. And so this is why there's sometimes a lot of debates on some startups, because however much cash you put in, they will never be profitable because the unit economics don't make sense. I would really encourage also in the Series A, Series B stage, like you need to have a lot of financial literacy. So if you are not financially literate, or if you don't have someone in your team, you really need people that can do modeling, that can really extract key financial outcomes, that can have a conversation with counterparts, and you yourself as a founder be comfortable with those things, because a lot of the due diligence is going to be on the financial models and on the numbers, beyond kind of the idea, the problem, the product that is going to happen. So I'll maybe stop here on that, and then the journey there. And then the next thing I wanted to do before we kind of move into questions is go through my key takeaways on fundraising. So I've been kind of on multiple sides, and I've gone through the ups and downs of fundraising, good ones and bad ones, and have talked to a lot of entrepreneurs doing this as well, especially in the last 4 years as I've been in the driving seat as the founder. And so I've kind of tried to boil it down to 10 key takeaways. So I'll start going through them, and of course we'll be super happy to respond, to talk about it in more detail, or get questions on them.
Yeah, so just before you start, I just want to give a little shout out to those who turned on the camera. Actually, Alexandra, other people, please also turn on the camera, guys, and write your questions into the chat, because very soon Mikela will be able to answer them, and as well react using your reactions in Zoom. Just we will be able to see that you're active, you're here, and you're interested in everything we're talking about now. So thanks.
Thank you. Yes, I have no idea if what all I said makes sense, but we'll see in the questions. So obviously the first big takeaway is that market conditions have a huge influence on your ability to raise. And so when I say that, is basically like the financial markets, obviously the political situation that you all know far too well, and that will make a big difference. So as an example, when we started the company, so this is 2019, this was kind of a booming phase. There's a lot of capital, and so you're kind of in a lot of a bit in a winning position, where there's a lot of capital that needs to be deployed, and everybody's looking for the best founders, but it's basically a founder's market. So you're really you have much more choice, and the valuations are higher, right? So you can have less metrics, but still the valuations are going to be high. If you're a very, amazing team, good product, and so on, you can even get competing term sheets, and people are going to start, bidding on top of that, and you can really bring your valuation up. And then we had COVID. So of course, as you know, everything dries up, all the funds are removed. This is really difficult to fundraise. And you basically have to really take the conditions of the investors and often compromise. And then again, in 2021, full boom, mega market, like insane valuations and so on. And then of course, now today, after the financial downturn and so on, we're back in a very difficult situation. So I would say right now it's a very hard investment market in general compared to how it's been, in 2021. And listen, it's not going to stop you from raising, or it's not going to stop you from building your company, but it's just you need to have that awareness, because the dynamics are going to be different. And so investors right now, for example, are much more critical of your metrics. So you need to have those proof points, whatever you are at this stage, is really in line. And also they are looking at profitability in a much more focused way. So even if obviously you're not profitable right now, but they want to see how you're going to get to that profitability, or to that, that unit economics that really makes sense. And so in the way you think about your growth, in previous times, like literally it was all about growth. So you might be doing financial forecasts where you're like, growing the revenue by, 20x and growing, tripling the team and so on and things like that. This is in this market, you can be much more conservative and really think much more about profitability and unit economics of your product before you go to those big growth stages. One could argue it should have always been that way, but there we are. So this is, you just need to be very aware of those conditions. The second takeaway for me is that it's a total numbers game. So you just have to see fundraising as a sales pipeline, right? So if you want to get one investor, you need to have 100 conversations, right? And you need to filter that through your funnel. And ultimately, you just need 1 or 2 investors that are gonna invest in your company. You don't need 10. You're just needing like 1 or 2. And so it's really being very good at being able to scale yourself in that process. So that means that, as a founder, you need to be able to send a deck to 10, 15 people per week, right? And have those conversations and follow up and filter very quickly. But it is going to be essentially a numbers game. And yeah, be extremely selective in the filtering. So like, I cannot emphasize this more, because there will be a lot of people that waste your time, a lot, right? So there's going to be funds that kind of know they're never going to invest, but they want to learn about the industry. They are curious. They see maybe another competitor coming on the market, so they want to get information from you. So you have to be very selective and like, okay, are these guys serious? Are they responding fast enough? Are they interested in our space? And then you need to do like literally the matchmaking of, this is our stage. Is this their stage? We are, are they deploying capital right now? Do they have bandwidth to actually look at a deal right now? And so you need to be asking very early on those filtering questions so that you know that if you're wasting your time with someone or not, and you need to put in your energy to maybe another fund that's going to be a much better fit. So I would be ruthless about, that selection criteria and how you do that, even before you go to market, really building that list and being very clear with the type of funds that match your business. And then the other thing is think about the investor experience. So, in a fund, you're going to speak to multiple people. There's, of course, going to be the partners that are the ultimate decision makers, but then you're going to have, the investment committee. There's going to be the associates. They're going to be the analysts. There might be a principal. There's going to be a bunch of people involved. And so each of them are going to be looking at things at different angles, and you kind of have to be ready for that. So the partner is going to be a lot around the relationship, the market, understanding you, demos, and so on. But then for the analysts and the people that do all the work behind, they're going to have to go and like build decks and memos for their team about your company. So anything you can do to make that easier for them. So for example, very concretely, we build on Notion a whole page where they could really navigate everything. So we had details on the market size, we had customer profiles, we had sales cycles, we had reviews on the tech, demos. Like it was kind of a fully organized Notion, and we could just send that to them and they could spend hours, looking at the data and bringing, and translating that into their format and their memos. And we got so much compliments on that. And that made the process much easier, because you're not there answering all their questions one by one, but you're preempting their questions and you're putting documentation in there. And even further, like when you're fundraising and you're hearing maybe the 5-10 questions you get every time, build an FAQ, start repeating the questions, you put it in your documentation already. So you start really being ahead of what's coming through and what you're going to be asked, so that again you can scale yourself in that process. The other thing is controlling the process and embracing FOMO, fear of missing out. Unfortunately, the absolute truth about fundraising, and I think this is a bit unfortunate, but it is how it is that it's very FOMO driven. It's very FOMO driven. So, if investors are hearing about you that, oh yeah, this company is raising, they already have a term sheet, like, you're basically like, there's a bit of hype around you, they're all gonna go and try to focus on you. Again, I think it's a bit of a vanity metric, but it's just how it is. And so, if you can play into that, that will make your fundraise journey basically faster. But to be able to do that, you need to control the process. That means that you need to go into the market with a very set timeline, like we are fundraising now. Our fundraising has opened. Can we have the first meetings? And then 2 weeks after, hello, dear, we're now in the middle of our process. We're already in advanced conversations with few funds. Would you want to move ahead with us? So you're basically taking them all through that funnel a little bit at the same time. Because the problem is, if you have somebody, for example, that's already doing due diligence on you and you're still having early conversations, you don't want to be in a situation where those guys are waiting or you're making them wait and you're still in that early stage, but you're trying to keep everybody a little bit at the same time. And anything you can do to kind of update them on your traction in the fundraise. So for example, if you do have a due diligence call, you should say, we're now starting our due diligence calls. Or if you have a term sheet, of course, like we now have a term sheet, like we're moving fast. We want to have all our meetings done in the next 2 weeks. That creates a sense of timeline and urgency, and you're controlling the process. And again, putting yourself in their shoes, this is really important because they're looking at tons of companies and tons of deals. And so they can just make you wait because there's going to be another hot deal that they're looking at. So you have to come front of queue and make sure that they are dedicating the time and the resources to look at you. So anything you can do to control the process makes a big difference. Of course, learn from the feedback. I just mentioned it, but it's a fine line between like, don't listen to VCs and they don't know your company, and like listen to feedback. So if one investor is telling you like, this makes no sense, or I don't understand this or whatever, it doesn't matter. But if like 15 investors or 20 investors are telling you the same thing and you really see a pattern, you might want to ask yourself, okay, there's really something there. Do I genuinely need to change something? Or, at some point ask yourself, okay, are we ready to raise? Like, do we actually need to solve this first before we're able to go to the market? So again, it's a fine line, but I would try to see those patterns and see how much you can solve that really quickly while you're fundraising. Choose the partner, not the fund. So I remember somebody telling me this, and I didn't really internalize it at the time. So you're going to have a lot of like really cool funds names, but at the end of the day, you are working with a partner, and that partner potentially might join your board. And once they invest, your full interaction is with that partner. They are the person that you're going to be on phone calls with, that you're going to solve crises with, that you're going to, be asking permissions on key decisions on your company to. So you really need to spend time with that partner and ask like to yourself, like, do I want this person specifically, not the fund, to be part of my company? And I would really do a lot of due diligence there. So that's my next point, doing your DD on funds. You need to do reference checks on them. So you need to speak to at least, this is probably more once you go a little bit further into the stages, right? Where you're maybe like in due diligence with them. You want to be speaking to 2 or 3 of their portfolio companies. Of course, if you can get an introduction via a portfolio company or another founder, that makes a big difference. But you really need to have those background checks. And also from a first-hand experience, I would be quite careful with first-time funds. So these are funds that are raising for the first time and that are still in the process of raising their funds. So they might appear like they're fully functioning funds, but they are first-time funds. And really asking questions of, do they have the money in bank to invest right now, or are they still in the fundraise process? Because especially with the markets right now, funds are themselves struggling to raise funds from LPs, from their own investors, and a lot of deals are falling through. And if you're at the back chain of that, that means that you might have a commitment and at the end they can't pay you. And we've been in that situation, and there's quite a few companies that have been in that situation as well. It's not personal, right? A lot of the times the reason they will not invest in you is a question of the fund, right? It's not the right sector, it's not the right stage, they don't have time, they're invested in another competitor, whatever it may be. So most of the time it's about this. So you have to get very comfortable with the no's. And then I put a caveat to that, which is also zero tolerance for abuse. I'm saying this especially for female founders on the call. You will get weird comments, and people might make you feel uncomfortable. And I think what I've learned is that at the end, you really need to have a tolerance zero for that. If somebody makes you feel uncomfortable in the way they're speaking to you, or the questions they ask, or the comments that they're making about you, there's no really way of recovering from that. And I think it's really quite important to walk away at that point, and like not to be over polite. And if something, it doesn't feel right with this person, you just really let go of the situation. And I know a lot of other founders that have been in this situation, and it's like, oh, but but what if, and maybe they didn't know. And I think we find too many excuses for those behaviors. And so I would really advise for like a bit of a tolerance zero mindset, and you will feel much more empowered also if you come in the mindset like that, because you are choosing them as much as they're choosing you. Although it might seem like the opposite way, it is a two-way selection. And then final, but really, I think it's the most important one, is take care of yourself, because fundraising is very tiring. It is exhausting, it's draining, because you are giving energy all day, right? Every meeting that you do, you have to come in. This is the first time they hear you. They have to believe in you. So your energy, your confidence, the way you come through is going to matter in an investment decision. And so it means you're giving a lot of energy. And often, you get asked hard questions. You receive no's. It's slow. It's frustrating. And so it's very, very draining. And it's, especially when you're trying to move fast, it's so easy to get lost into this. But I would really advise to take care of yourself. And that means sometimes taking some time off, doing things in between that energize you. So if that means spending more time with a team, or, going for a yoga or run, like whatever is happening. And especially in your case, again, I absolutely don't want to presume, I can even imagine what you're living through, but, you're already at a level of stress from your current situation. And on top of that, it's a lot. And so anything you can do to build up that resilience, that physical, mental resilience, that will make a very big difference in your fundraise journey. So that's it for me. I'll maybe close on that. I tried to share a lot of what I know, what I learned, but of course, there's so much more. So I'm super happy to respond to questions or comments, or anything you want to learn a bit more from.
Awesome. Thanks, Mikela. Especially, like, I have few comments about everybody on this meeting. If you have any, please write them into the chat, or like raise your hand and turn on your microphone, and you'll be able to talk easily. But let me be the first who will ask you a question, because you were talking like a lot about VCs, about like their attitude to you, and all like about the inner kitchen of how everything works. And you mentioned this former effect that makes founders talk about you, think about you, and want to invest in you if everything is good with your product. But have you ever faced with a station when you have this anti-former effect, when one VCs you as you mentioned, for instance, he made a bad comment about you, and you said I don't want to cooperate with you, and then you faced with this situation when other VC fund got information about oh, she's so uncomfortable, don't work with her, and so something like this. So
yeah, I see what you mean. If the other opposite happens.
Yeah. Well, so what should you do with it? And if it's so you should just go and talk to completely another VCs, and how should it be solvable?
Yeah, no, that's a great question. I think it depends on why you're getting the anti-FOMO. So if it's, for example, which is usually the case, it's oh, there's going to be something, right? It's going to be, oh, they don't have the traction yet. Oh, I'm just not sure about the product. Or whatever that may be. And you need to ask yourself, like, okay, is this a founder on really unfounded reason? And somehow you're going to have to tackle that. So in some cases, I would really advise, like, get off the market, maybe do a convertible loan note if you can, right, to give you a bit of runway, and or if you have runway, because at the end it's going to depend on that. And then go and solve that. So if it's like, no, those guys don't have traction, or you go and you spend time and you get those proof points, and then you come fresh. So there's a new story. It's like, oh, okay, those guys are back on the market now, but now they have this, or they hired this person, or they have this customer on board, or who, whatever.
So you just need to keep working.
Yeah.
As usual.
This is if there's like a genuine reason why you're getting like that NT thing. If it's like a superficial reason, or like there's somebody saying something about you, I don't know, something like that, I think you have to try and influence a bit the people. So as much as they're having coffees with people, you need to go and say your side of the story, potentially, because like the news goes very fast, but it's going to depend a little bit on the context. But if you see that you're really not going there, it's been months, like 6-9 months that you're on the market, you're not getting anywhere, sometimes it is better to go and reset yourself, especially if it's the same feedback all the time. Reset yourself, build some of those proof points, and come back fresh to the market with like a new narrative.
Awesome. Thanks a lot. And questions from Sergey Vlasko. First, Notion was more like data room or similar to pitch deck?
Yeah. So our Notion was it's a mix of both. So we basically had kind of, for example, sections. It's like a pitch deck with much more detail. So we would have, for example, a section on market sizing. So we would talk all about the market size, and then we would link, for example, to an Excel with all the numbers behind, or we would have like a whole section on customers, and we would go through the customer journey and like write all the explanation. We would have a whole side around tech and go quite deep around how our tech works. So it's almost like you're taking the deck and then you're going very deep in it with more detail. The data room, as in kind of a due diligence data room, we kept that separate. We kept that on DocSend. And this was more like, for example, contracts and, financial accounts and things like that, but we kept that separate. Notion was really tools to convince the investors to invest in us, but not necessarily to do kind of legal or financial due diligence. So hopefully that answers the question.
Sergey, actually, like I saw you were turning on a camera, so maybe you can also like ask a question by yourself. It'll still be more personal touch.
I'm in a noisy room, so please go ahead and read it.
Okay, perfect. So second question, what accelerators you could recommend specializes on sharing economy or sustainability?
Yeah, that's a good question. So, okay, so we have, I'm trying to think also the ones that are not too UK centric. So Plug and Play were very good to us. So, and they have quite different sections, like for retail, for circular economy, we had one, for example, specialized with the Alliance to End Plastic Waste around plastic circularity. That was really great. So them I would advise. This is more UK, it's called Tech Nation, and they have a Tech Nation Net Zero, for example. That's what comes to mind right now. What else did we get into? And let me have a think, and then I can share back as well. But these are the two that come to mind quite immediately. And I know like a lot of the, like, for example, Techstars and stuff, like, the kind of more well-known names, let's say, are increasingly now having specific sections for sustainability. And then in the selection process for that, I would really seek if they're connected, for example, with either very good other startups that are similar to you or your customer. So for example, is the the accelerator funded or sponsored by your potential customers that are going to be involved in the process? And that's what you want to be looking at as well.
Okay, perfect. I hope it's also an answer. Next question is from like very old, our community member Taras Reda.
I can ask it myself. And first of all, thank you for this presentation. It is great and very educative. And yeah,
Taras, you have like bad connection
what
now.
What are the good KPIs? Yeah. Sorry, then please read my question.
Yeah, I got. So how rigorous to measure traction on pre-seed stage and anything suggestion on set of KPIs. So this is going to depend a lot on your type of product. Are you B2C, B2B?
B2B.
B2B. Okay. So, at that point, I think it's going to be quite a lot around, for example, a customer that might want to do a pilot with you, or a trial with you, or that has written, or that might be writing you a letter of intent that if you have this product in a certain moment that they might want to be working with you. So I think, pre-seed is really quite hard to get that, but if you can't get to those commitments on even a free pilot, I would say it's more interviews with quite clear outcomes that this is something that they need, right? Like at the bare minimum, some sort of like really consistent data points that the customer that you're looking at has this issue, they would be ready to pay for it, and some form of, it being an interview or, data gathering by them to be able to have that. And of course, as much as you can, any sort of commitment to be working with you on that, even as a free pilot. And I did pilot, but
yeah. So commitment from the customer end that they want to work with me and they value the product I'm offering, and that's a good KPI for the traction.
The thing is, in a pre-seed, I would say it's hard to show traction per se, because traction means like you are, you have a metric, like a measurable metric that like revenue or pilots, or users or something, right? In pre-seed, you're so much like, you don't even have a product, you're in the discovery. So,
right.
If you, for example, if you're a B2C thing, I would say like if you have even B2B, if you have like a web page describing your product and you have people signing up to get more information or to get into the early, beta program with you, that's just showing interest. You just want to show a genuine interest from the customer in your solution, basically.
Thank you. That's very helpful.
You're welcome. And then I think
awesome. Yeah. And we have question from Katerina Stetsakova. I can see her like video, so I guess I will just read it. So Mikela, thank you so much for sharing your experience on such many vital steps of pre-seed stage. I feel that after your election, I have a specific and a well-structured roadmap to go. Thank you for making things clear. It's not a question. Yeah, okay.
Oh,
then.
thank you. That's
it's just very
no question there.
Thank you. Yeah, it's awesome. It's awesome. So please turn on your like mic or write into the chat your questions in order like to then be answered by Mikela. And Yulia raises hands, please.
Hi there. So I'm already raised my pre-seed. I have B2C startup in the mental health with possibility to also go to B2B. Our main metric is revenue now. We are from Ukraine, don't have time for free users. But so my question is, and we have like around 1,000 paying customers. So my question is, like, how big should be our revenue for raising a seed?
So that's a difficult question to answer, because it's going to depend on that quality of the revenue as well. So for example, is your product being sold on a monthly basis, on a yearly license basis? So you're going to have to look a bit at that. And then it's going to be also all the metrics around the revenue. So for example, if you're like, if you have 250K of revenue already, but you can see that those customers are continuing and that they're not falling through, and that you're adding customers at a rate of X, like those are equally important metrics. So usually by the time you go to Series A, it's around $1 million in ARR. So like really recurring annual revenue. So, anything that you're at a seed, like 250, 500, like that will already be quite a journey there. But it's more than the sub messages behind on what is your growth rate of that revenue. How much does it cost to acquire those customers? Are any of them, did you have any churn on them? How engaged they are with the product? Is there any possibilities to upsell to them? You're going to have to get into those things as well. So I since you're in an amazing position of already having the revenue, I would focus on a lot of the metrics around the quality of your revenue and your customer engagement, so that you can prove if you actually had more capital, right, to build a better product or have marketing and so on, you could see the formula, right? Like if I inject X, I could get X out of that, for example.
Awesome, thank you.
Yeah, and actually, like little question again from my
course.
side. Yeah. And so you're like talking about like unwritten rules. So we see like, for instance, that like different stages have like different requirements, which is obvious. But still, are there like any like points that you like talking to yourself that okay, if I knew it before, it will be much easier like to get a seed or pre-seed stage or Series A, but it's like not that obvious for newcomers into the startup world.
Yeah. I mean, I think the overarching, and I try to share it in the key takeaways, but there will be a lot of like things that are external to you that will define your fundraise. Right. And that can be the market. It can be what people are thinking right now about the technology. So for example, like crypto and Web3, it's like, ooh, wow, like what's happening there? But like AI is still cool. And you just need to get a bit the understanding of where the impressions are at of that VC. And the thing is, those things change. So you need to get out there and get the feedback and get a little bit that sense of where it is. And some things you control and some things you don't, but you just need to be aware of them. So for example, the fact that the market is really crap right now, like you don't control, but it's just going to mean that valuations are lower and you can't really, that's not going to change, but you just need to know that and go to market accordingly and build plans accordingly. And then I think the other unwritten rule is that I thought, that valuations were done in a very kind of mathematical, like considerate way. Maybe they are sometimes, but there are some revenues of revenue multiples and so on, but there's also an aspect again of the market conditions. And it's just that right now, startups that are at this stage with this level of revenue, are around X valuation, and that in 2021, the same company creating some hype would have been triple the valuation. And you can see that, right, with those companies that now have to kind of slash down and do down rounds and all these things. So that just gives you the signal of like that sometimes it's a bit, it's not really rooted in anything very concrete, except from,
Yeah, it's actually a very important point, especially for mental health, when you're like doing your best and then you understand that it's not growing and you think that, oh, it's my fault, so what I'm doing wrong. but then it turns out that maybe market also like have impact on that.
Completely. So it's so important to protect your mental health. Honest, I cannot emphasize it more during a fundraise because it is really hard. It just is. And maybe for some group of people that are in specific privileged places that and look a specific way, like they can get fundraisers done in like 2 weeks, a month, something. But the reality is that for 99% of entrepreneurs, it's a really hard process. And it takes a lot of resilience. So you need to take care of yourself while you're going through that process.
Yeah, for sure we will. And raise hand by Andrew. So please turn on the mic.
Hello, Mikela.
Hi, Andrew.
So I have a few questions for you. The first one is, so for example, if you're a profitable startup and which is quite rare, and you're on the seed or Series A, like is the fundraising is different, like, and what is the process, for example, for convertible debt or some other type of debt financing? Like maybe you can advise something.
Yeah, so I'm not an expert in that, so I can't pretend to give you like a lot of detailed advice on this. But first of all, I think today in this market, if you're a profitable startup, you're like, wow, this will be appreciated much more than maybe like a year ago, for example. And so that means that venture capital might also be interested in that if they can see that there is a path to really grow the model that you have today, right? In terms of debt financing, again, I'm not a really expert in that but we have looked into it. And my understanding there is basically, do you have enough repeatable revenue and like forecastable revenue that you can take on debt? And I think that's what they're going to be looking at. And that's the risk for you as well. And so if you've reached that stage where, there's really like, that if you put X amount of marketing or you have X amount of salespeople on the ground or whatever that may be, that you're going to deliver those numbers, it's like the formula is there, then I think you might be ready to go speak to those people. If it's still like up and down and like some months yes, some months no, and then, there's more uncertainty, I think it will still be quite difficult to get right conditions for debt financing. But honestly, I'm not an expert, so I would look into it, but that's my first initial kind of reaction from what I know.
Yeah, cool. So, and another question, right now we are incorporated in Europe, but we have like a few spin-offs from our company, and we are curious about the new legal entity, and we're deciding between like US, Delaware and Wyoming, and United Arab Emirates because of the low, like basically zero taxes and everything else. Like, does it matter for investors, for example, if you will be incorporated in Delaware or in United Emirates? Because basically for us the difference is mainly fees.
Yeah,
and that's it. Yeah.
Yes, it does matter, because some funds basically will have, actually most funds will have specific mandates on which geographies they invest in. So some investors will only invest, for example, if you're incorporated in the US, for example, and they might not invest if you're incorporated outside of Europe and in other places, for example. So I think you do need to take that into consideration for your, if you're thinking of fundraising, like on where you're going to incorporate and essentially where the right capital is going to come for you. If you think for the type of company you're building, for example, that it's likely to be US, then it's probably worth looking at a US incorporation, for example. But if it doesn't matter, and if the capital can come from somewhere else, then maybe not. But it will matter for the funds.
Gotcha. And what is the best legal structures, like C Corp or LLC usually?
Again, I'm really not an expert in this, but my understanding it's more LLC. But I
Gotcha.
will not pretend to be.
Yeah, What about your company? Like, do you have like LLC?
No, so we are incorporated in the UK as a limited company, and then we right now don't have any other legal entity elsewhere. But for example, even that made a difference. So for example, some European funds, it was more difficult for them to invest in us because we were UK and not Europe. So it does really make a difference. Like,
yeah, gotcha. And why have you decided to go with UK?
just because we are here, like we're based here, the team was here. It kind of happened.
Gotcha. Cool. Thank
Good
Okay,
you so much for your
yeah.
answers.
Thanks, Andrew. And Yulia has more questions.
So yeah, I have quite a weird question. So, but you have more experience than me. So, what is a good way to check? Is there a Russian money in a fund? Because I spoke with some like well-known European fund, Berlin, and somebody say to me that, oh, but there is a Russian money there. So what is a good way to check?
To be honest, I think it's hard to check like online or something, but I would just ask very straightforward when you're having those first calls and you just say it like, for us, we want to know if you have any of your LPs, your limited partners that are from Russia, or if there's any Russian money in those funds. I would just ask the question. And then at some point it might, like if you're really advanced and you actually want to verify, you might want to I think you might be able to ask like their records or stuff like that. But I think it's very hard to get that information unless you're asking it. And of course, unless they completely lie to you, which I hope they wouldn't, I would be very upfront about it. And I think it will be more than justified for you asking that question.
Awesome. Thank you.
Okay, thanks a lot. Actually, I wanted to mention that Yulia and Mani's team were on TechCrunch Disrupt in California. Yeah, including like our Ukrainian team that went here. So congratulations on that, Yulia. And
cool. Well done.
Yes. So actually, any more questions, guys? So we already like had nearly 1.5 hours, so maybe like time for last questions if you have any.
Yeah, I have a short questions about like Series A. So what are the average multipliers? For example, if like the company has, I don't know, 1 or 2 million in average recurring revenue, like how investors usually evaluate that?
Yeah, so this is, again, as I said, we've seen kind of like the 10 to 20 X multiple from revenue, from annual revenue. But given how the markets change and how they're moving right now, like even because we raised 6 months ago, now the market is different. I would get a sense right now from some friendly VCs or other founders of where it's at, because that has changed.
Gotcha. So, and what was the average multipliers like, I don't know, 1 year ago and right now, maybe just like from your gut feeling?
Sorry, you mean the valuation?
Yeah, the valuation based on revenue.
Yeah, that's what I would say. I would say like around 10x to 20x. But the thing is, you can't be too stuck on that either, because at the end of the day, there will be multiple factors that define your valuation. The revenue multiple will be one of them, but there will be other things. The team, the potential, the quality of the revenue, the market, like that, if you have multiple offers, like there's a multitude of things that influence that. And very selfishly, from your perspective, I would be looking at like, how much money do I need? How much am I ready to dilute? And you need to get yourself in a range of like, I'm ready to be in this range of valuation. basically. And you need to think of it
Gotcha.
more that way.
Sounds great.
Thanks a lot for answering. And again, like I saw just Alexis turned on mic and camera, and he didn't ask any questions. So if you have, we can.
No,
like...
it was not a question. If you want to know multiples, just do competitive benchmarking on PitchBook or something like that. It's just so easy.
Yes, that's a very good point.
It was nice comment actually. So yeah, actually very important information for the last part. So please, I will now drop link to our Slack. So if you're still not here, please come in, because here you'll be able to ask more questions from Mikela and other coaches, and as well as talk to other people who attend the coaching sessions, and you'll be able to see who will go next on next coaching session. And I will really ask Mikela, I saw this legendary list of your top 10 how you say it, secrets and that you got through your career. So if you'll be able to drop it into Slack, or just drop it to Sasha or me in written forms, then we'll be able to share it, because it's really nice, information that should be with every startupper. And I have already several people who asked me to have them in written form, so it'll be really nice.
No problem. I'm very happy to share that.
Thanks a lot. It's perfect. So again, we'll just ask everybody to unmute or just say thank you, or turn on your camera. Thanks a lot, and hope to see you soon.
Thank you.
Thank you, everyone. Good luck with your startups.
Thank you very much for your answers.
Thank you.
And your advices.
Thank you.
Bye.
Bye-bye.
Bye-bye.